Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, my guest is Chris Younger. Chris is a founder and managing partner at Class 6 Partners in Denver, Colorado, which is an investment bank and mergers and acquisitions firm helping business owners grow the value of their business and ultimately bring it to market, structure deals, and execute transactions with sellers. Chris has been in this game for quite a while. He has a wealth of experience. This is one of my favorite conversations we've had on the show to date because Chris is really easy and fun to talk to, and he is really smart and experienced. He has experience at the London School of Economics. He went to Harvard Law School. He practiced law in Silicon Valley for a short time before getting into deal making, and he just shared a lot of wisdom on the show today. We covered what business owners should start to think about, when they should start thinking about this, if they're considering a potential exit from their business, what some of the first steps are, what you can do to grow value, what you can do to screw it up and destroy value in your company, and what the change in interest rate environment has meant for the private equity and deal-making space because it creates an entirely new landscape for the way these deals are structured. The more expensive that debt is with higher interest rates, the more challenges these are to bring these deals to close. And Chris very succinctly walks us through the dynamics in the market today. So this is a great conversation. I hope you listen to the entire thing because he's just very wise in this space. And I hope you enjoyed as much as I did. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Chris, welcome to the show. I'm really excited to have you here, and I'm really excited to talk to you about mergers and acquisitions and business exits. Thank you for sharing a little bit of your time.
Absolutely. Well, thanks for having me on the show. I appreciate it.
Why don't we start with this? You have been a participant in a whole bunch of deals, M&A deals, in various capacities over your career. How did you fall into this field? Tell us a little bit more about your background and how you got into it initially.
Well, how long do we have? I started as an attorney. I wasn't very good, but I practiced in Silicon Valley for a couple of years and concluded that was not going to be my ideal path. And then I left and I worked for a group of investors out of South Dakota, of all places. And through that, started a roll up in the communications industry. And so I was the deal guy. And by the way, not a very experienced deal guy. I'd been practicing 2 years of law. And then I was, expected to manage all these transactions. So I was way, to use a Colorado metaphor, way out over the tips of my skis.
I use that metaphor a lot. And tell us more about, so at Silicon Valley, you figured out you didn't want to be an attorney, pretty green in deal making. How did you get to South Dakota? That's quite a jump. How did you meet the group? Why that jump?
You can imagine the conversation with my wife at the time. Hey, we're going to move from Palo Alto to Sioux Falls, South Dakota. How's that sound? Fortunately, she's hung in there with me. And but it was a guy that I had gone to law school with. He and I were going to start a search fund, which is you basically gather some capital and spend some time looking for a business to buy. And he and I were going to buy a company and run it together. And as we were out looking for capital, we came across this group in South Dakota who was looking for some folks to help them invest their capital. They were a subsidiary of a utility, and so they were investing in unregulated businesses. And so that's how, and my buddy was from South Dakota, and so that's how we got connected. And So in any event, with that started this roll up called Exponets, and so we did 27 acquisitions over about a 2-year period. So it was pretty hot and heavy, and lots of mistakes along the way, as you might expect, particularly given how green I was. And we were very, very fortunate to hire as the CEO of that business a guy named Jim Walker, who's been a not only a friend but a great mentor to me over the years. So I went from being the deal guy to after we got the deals done, I became the chief operating officer and then ultimately the president of that business. We built it. Those 27 deals, I think we were about $1.2 billion, $1.3 billion in revenues. And then we hit 9/11, the downturn, the dot-com bust. And that's all while we were trying to integrate these businesses and do a big systems cutover. So you can't tell how tall I am from this podcast, but I was a lot taller before I went through that experience, trying to integrate all those acquisitions. But we got it. We integrated them, and then we sold the business to Avaya, which is a big communications company, and that that whole experience, you learn a lot. There was a lot of learning compressed into 4 or 5 years, and then basically I tried to retire, and I was way too young to retire, as I learned. And my team's heard this joke 1,000 times, but I was reorganizing my wife Mary Beth's spice drawer. And I won't use exactly the language that she used with me, but she said, "You need to go find a hobby." So that's when my partner and I started the investment bank. And since then, that was 20 years ago. And today we have about 50 people. We have a consulting group called Pathfinder, which helps businesses grow and get ready for a transition. And then we've got our investment bank that manages the exit. And it's been a blast. I tell people I have the best job in the world because I get to work with talented entrepreneurs every day, and we're pretty picky about the clients that we take on. And so these folks are not just great entrepreneurs, but great people. And so it's been a blast, and looking forward to the next 20 years.
Very cool. How do you go? So when your wife says, "Stay the blank out of my spice drawer,"
yeah.
How do you? What are the first steps to starting an investment bank for our listeners out there? Do you start on more of a consulting role? It seems like that would be a pretty reasonable place to start, so you have some client relationships and recurring revenue coming in before you're doing all the capital formation kind of stuff. Where did you start, and how did that go?
So we basically, and I will tell you, had I known how long the path was to positive cash flow, I may not have done it. But if you think about our business, you're meeting business owners, you are meeting lead referral sources, you're trying to explain to them, hey, why they should trust you. I mean, I had done a lot of acquisitions, but we hadn't done, an investment banking type. I hadn't represented a company. I'd always been a buyer. And so, and we were very fortunate. Bob Grabowski and Ann Padilla, they owned a staffing company, and they were the first client to put their trust in us. And, I think our fee was a whopping $30,000, and that basically went in to pay for furniture for the office. And then, we've been very fortunate. We've had great clients who've referred other clients to us. And we kind of just built the business. I would call it the old-fashioned way. Just try to do a great job, make really happy clients, and then continue to get referrals into other clients. Today we've got a much more significant business development engine that we've built, particularly on the Pathfinder side. But back then it was, like I said, kind of the grind it out. I think it was. We started the business in 2005. I don't think it was till 2007 that we had revenues. So it was pretty lean. But my wife was happy because I was out of the house, so that was good. And I stayed married, by the way. So
excellent. I'm familiar with that approach. That's what my startup experience was like with Hartford back in 2014. It's a pretty brutal ramp up for financial planning, just as it is investment banking.
For sure.
So you had a a wonderful experience set to take to the investment banking venture. Now, fast forward, you've got 50 employees, you have the business development engine worked out, and you're doing a whole bunch of deals as an organization. So walk us through some general wisdom for our business owner audience when it comes to their own exits. And keep in mind that our audience is probably smaller size organizationally than your typical client. We might have some tech-oriented businesses out there, but most of them are going to be more professional services, local manufacturing, that kind of stuff. All that have value in their equity and transferable value, but your landscape is a little bit different. So if you're in this position, let's say that you're 60, you're starting to tire out a little bit, you want to be out by 65, what's the timeline for all this? How soon do you need to start thinking about it? What are some of the first steps?
So what we've learned in watching different companies go through transaction and transaction planning, if your goal is to retire at 65 and you're 60, you kind of want to plan to sell the business in 3 years so that you can commit to that new owner. Hey, I'm available and willing and would love to stick around for a couple years. I think for most of our clients, that willingness to stick around for a couple years reduces risk for the buyer, and a reduction in risk translates into an increase in value. And it's not like you're committing to stay around for 2 years, right? Because the new owner may say after a year or after 6 months, I'm good. I've got everything that I need, and the business is doing well. I also think for our clients sticking around, it helps you as an owner protect your team and make sure that transition goes well for not just your team, but for your customers and the brand, which I think for most business owners is very important. Hey, if I'm 60 and I want to exit in 3 years, well, when should I start planning? And we would say that now's a great time. Any time, anywhere between 2 and 5 years ahead of a deal, if you can start to triangulate between what is it you're trying to accomplish financially and qualitatively with an exit, and then get a really good assessment and objective view of where your business is today, at least that demonstrates or helps illustrate what the gap is. Hey, we've got a business today that's worth $3 million and I want to get it to 10. What do I need to do over that 3 years to make that happen? And that planning and that execution we found to be just, I think most entrepreneurs, by the way, are really good at executing. Sometimes they're not great at focus. So a lot of our job in our Pathfinder business, the consulting business, is just, hey, how do we help them get a little bit more focused? How do we help them identify areas of risk in their business where, hey, that's going to be a problem for a buyer, and so that's going to reduce value and make the deal harder to execute? So if you're 2 to 5 years away from when you want to transact, and then, hey, 4 to 7 years away from when you actually want to retire, that's a great time to start planning. It's the amount of work that's required to get a business ready to go to market is significant. We've estimated about 1,500 hours between our team and the client's team. You can try to cram that into a couple months, just take the business to market, or you can spread that out over 2 or 3 years. As with any business process, the ability to spread that work out and really be thoughtful, you're just going to get much better results. And we see that time and time again.
Right. So 60 might even be too late if you want to be out by 65 is what I'm hearing. And, like any big decision, if you're trying to cram a whole bunch of important stuff in a short period of time, you're not going to be very thoughtful about that along the way, as you put it.
Well, we have an assessment that we use. We call it a business health assessment. It's got about a couple hundred questions, just designed to help us uncover potential issues in the business. And what we know, and we've had 1,000 companies take it, what we know is every business has issues. Every business has risk. The question is there anything we can do about it? And again, the more that we can fix and optimize that business before going to market, the more valuable that business is going to be and the easier the transaction process is going to be. So again, if you're just trying to go to market in 2 months, your ability to fix anything is very limited. If you're going to market in 2 years or 3 years, your ability to fix stuff is much, much more expansive and available to you. And so, why wouldn't you want to do that?
Right, right. I like the way that you frame it too, in terms of triangulating where you're at now through an objective assessment of value and what you want and need financially and qualitatively from the transaction after taxes when it's all said and done. And this seems like something that's pretty basic, right? You'd think that, if this is a retirement transition for you, you better be darn sure that when it's all said and done, the amount that's left over after taxes is going to be enough for you to live the lifestyle you want for the rest of your life. And so let's use that as part of our target in structuring the deal and making some of these decisions about how and when you might want to grow the value over the next few years prior to the deal. We talk to a lot of people that just haven't, that just hasn't occurred to you, right? Because when you're in the weeds of your business, it's pretty easy to lose the forest from the trees sometimes. But I like how you put that, because you need to have some target down the road to shoot for, because that informs the rest of the deal structure and decisions along the way.
Oh, for sure. I think one of the things that we've seen, I'm sure you've seen it as well in your practice, the business owners are a lot of times surprised at, hey, I don't need my business to be worth 25 million in order for me to get done what I need to get done. 15 million is plenty. So to your point, I don't know that they've done a lot of thinking about what those needs and requirements are and what type of sale would actually meet those needs. The other piece that we do a lot with clients is just, hey, you want to be running to something, not running from something. Where we see owners get in trouble is, they're stressed out, for whatever reason, that causes them to want to sell their business. Well, after 6 months, 9 months, a year, that stress level obviously will have been mitigated substantially. But without something in their life to give them purpose, they're a little bit lost at sea. And I've seen this with clients over and over and over again, particularly maybe younger ones where, they think that their goal is to retire. But, hey, golf after a while or whatever their hobby is, that only takes so much time, but it doesn't provide them with what I would call kind of really qualified purpose.
Right.
And so having that conversation is also really important to make sure they know, here's what I'm going towards.
Absolutely. And stay the hell out of my spice drawer. You gotta,
Yeah, exactly.
People in the family to consider there too.
Well, we always talk to the spouse as well, because we want to understand from their perspective, hey, what's perfect for them? And oftentimes that's the first time that the spouse and the business owner have had that conversation, and it's usually pretty illuminating. Sometimes uncomfortably so.
Yeah, right.
So,
right. So let's say you're in this situation. You're thinking about transitioning out in 5 years. You want to go from 3 million to 10 million. You have options at your disposal in terms of driving the value. What are those options? What do you typically see those options as being? And obviously it depends on the industry and the specifics situation a little bit, but I would guess that you probably see some commonalities as avenues to drive value over that period of time.
Yeah, as I mentioned, so we have this health assessment that we use with business owners, and the most common risk or issue or challenge in a business that we've seen across, it's like 95% of the surveys this comes up, is, hey, that business is way too dependent on the CEO or the business owner. And that can manifest itself in a bunch of different ways. Either they're spending way too much time in the business, or they're the primary the relationship manager for key customer or key supplier or key strategic relationships. Maybe they're the kind of the innovator, the primary driver for product or service development. And so one of the things that we spend a lot of time with clients on in our Pathfinder business is, well, how do we get that business to be a lot less dependent on you as the business owner? And a lot of times what transpires is, once they have been able to analyze and prioritize their time and start to orient their time more around the activities that they really enjoy and are good at and that add value to the business, what that does is it helps them see the value of developing a team. Often many times where that team is actually better at executing than the founder. And if they do that right, not only does it drive a lot of value in the business, it actually relieves some of the pressure on them to sell the business, because now they've gotten more of the life that they want. They love the work that they're doing. The business is doing well, so that, hey, they're much more indifferent to whether they get a liquidity event, because they kind of have that life that they want. And
Hmm.
that's a big driver of business value, right? I mean, we have a great example of a guy who we worked with him for probably 3 or 4 years, but it was a business here in Denver, Colorado, and he not only did he get himself out of the day to day, he moved to Florida. And so when we went to market, we were, with all integrity and honesty, be able to tell buyers, hey, Mike's not involved in this business anymore. He gets his quarterly reports, and obviously he's getting the cash flow from it. But he's got a whole team in place that's managing this business. And as a result, that business was a lot more valuable when we went to market than if, he had continued to be the primary driver in that business.
Yeah. Yeah, that's a great point. And one thing that I've picked up over the years is that good exit, whether you're about to approach your own retirement or not, good exit planning is just good business planning, and
For
vice
sure.
versa. And it's a topic that often it's easy to push to the bottom of the to-do list for entrepreneurs, but it really becomes vitally important as your organization grows and as revenue grows, because it simply reduces overall risk and, provides some nice balance in the right situations.
Well, yeah, we've seen a lot of business owners where they, their comment is, I didn't realize that I could design the business this way. Often they're, like I said, they're locked into the day to day and managing all the fires that, whether they've created them for themselves or the organization has created it, and they're dependent on the owner to put them out.
Mm-hmm.
The ability to, because most of these business owners got into the business for some reason, and helping them rediscover that, and also help them reduce the day to day stresses that they're experiencing today. That can make the business a great asset for them that they may not want to divest, but it's generating a lot of cash flow for
Right. Right. So where do you see people screw it up? You're at 3 million. You want to go to 10 million. Where do people go wrong in all this?
Back to the earlier point, trying to do it themselves, not recognizing that they need a team. I think the other piece is not having sufficient focus, where they're trying to do too much. Or a lot of entrepreneurs, if you think about why they've been successful because they've been innovative. They've come up with a new way to do things or a new way to approach the market, and that's been successful. And like all of us, we're gonna revert to our go-tos when things get stressful or things get challenging. And often for the entrepreneur, that's innovation. Well, it may be that you don't need that much more innovation. You just need execution and focus on the things that you've already innovated with. We have this conversation with entrepreneurs all the time. And part of our job is to be able to show them we can get to 10 million, and we don't have to there's no more high jumps in this business. We can just execute and do the blocking and tackling with what you already have. And we can get there. And sometimes that's an illumination for the entrepreneur to say, oh, you mean I don't have to take the kind of risk I've taken in the past to get to where we are right now? Absolutely. We can dramatically reduce the risk profile in your business, get you more focused, and that'll generate the result that you want. And without having to, execute a really difficult degree of difficulty dive to make this happen.
Right. Right. And to your point earlier, anything that you can do to reduce the risk, either by having a team around you or any other, activity or strategy, is going to, by default, increase the value of the company, because the buyer is going to pay for it what they think they're going to get after the transaction, and you're just taking uncertainty off the table for them by doing so.
For sure, yeah, 100%. It's like I said, we've watched the movie, a couple hundred times, so we know how it ends.
Right. So one thing I'm curious about here, Chris, is the landscape for all this. And as I mentioned earlier, I think a lot of our listenership are more modest-sized professional service organizations. And when you're approaching a potential transaction like this, if you're below a certain size, it probably makes more sense to go see a business broker than it does an investment banker like yourself, right? And then you have consultants, you have your CPAs and attorneys, and hopefully financial professionals who are kind of on your team of professionals and advisors. What does the landscape for all this look like? And when do you think it becomes reasonable to consider an investment banker versus your local business broker?
Great question. In our world, I mean, the audiences that we reach out to on behalf of our clients are typically institutional investors. These are private equity firms or larger businesses that are looking for strategic acquisitions, and those types of buyers generally become relevant as a business is earning more than $2 or $3 million of, we call it EBITDA, earnings before interest, taxes, depreciation, and amortization. But it's really, hey, as that cash flow of that business exceeds $2 or $3 million, that's when these types of investors are going to be relevant and interested. We have a lot of clients that show up and maybe they've got $500,000 of earnings or $1 million of earnings, and we tend to talk ourselves out of that business because, hey, this is just not going to be a great fit for you. The type of people that we're going to go approach, it's not going to be a good fit, and we're going to be overkill for what you likely need. And so, kind of less than a couple million, it probably makes more sense to look for a high quality business broker in the community. And usually, counsel, an accountant that you've worked with, or maybe a lawyer that you've worked with, or a financial advisor, they probably have a good sense for, hey, in that vast universe of business brokers, which one of those is going to do a great job for you? The level of attention tends to go down. The level of detail, the level of team tends to go down as you go into the business broker ranks versus, when we're doing a deal, we've got, 4 or 5 people on the team that are focused on that. And so that becomes a big determinant. Now there are exceptions, right? If you're in a particular industry like software as a service, as an example, those businesses, maybe they're $5 million in revenue and maybe making $500,000, but they're growing really quickly. There's a good market for those types of businesses. As you mentioned, for professional services businesses, yeah, they're going to have to be 10, 15 million in revenue, $2 or $3 million of earnings. You're going to have to answer that owner dependence or partner dependence on those types of deals and really be able to demonstrate, hey, this is a really scalable business without the top people. But if you can do that, hey, there are buyers for those types of businesses out there that, we've had some success with. In general, though, hey, if you are going to hire a business broker, you're going to want really competent counsel and other advisors around you to make sure that, hey, you've kind of dotted all the I's and crossed the T's.
For sure. And when you say a couple $1 million, I would guess that we're thinking EBITDA, as you mentioned, free cash flow, seller's discretionary earnings, all kind of in the same bucket that we're talking about, right? As opposed to top line revenue.
Yeah. On the seller's discretionary earnings, one of the things you've got to pay attention to is, hey, if you need that person going forward, you still have to account for some reasonable compensation for them that's going to keep them in the game. And so you want to be careful on the seller's discretionary earnings calculation, because what you don't want to find yourself in is, hey, I paid for a business that had $1 million of seller's discretionary earnings, but I had to keep that person on board at $300,000. So my real earnings is only $700,000.
Right.
Yeah.
This brings up a really interesting point that we've run into in the past too, and that's that if you're in this situation where maybe you're doing a couple $1 million of revenue and free cash flow is maybe half that, just throwing numbers out of a hat here. There is a market for these businesses, right? That has value. You can sell it, and you can get a nice multiple on that cash flow. But you should absolutely consider the fact of this threshold that Chris is describing to us. Because if you can double it and get up into that threshold that Chris is describing, you're opening the business up to this brand new pool of big money institutions that for a living buy businesses like yours. And so this is something you ought to be aware of, is if it's the choice between, transitioning over the next 3 or 4 years, but maybe sticking it out for a few years beyond that in order to access that new pool of potential buyers. That is a very, very substantial potential multiple that you can access.
For sure.
And I can't really put numbers. Can you put numbers on that?
Yeah, I mean, you
can't
could
with
double the
confidence.
multiple that somebody's willing to pay for a business, right, as it grows. Because a business that's doing $2 or $3 million in earnings, right, EBITDA, compared to a business that's doing $500,000, there's going to be a lot less risk associated with that business because it's more scaled. It probably has a deeper team. It's probably got better customer diversity, revenue diversity. All those things are going to drive that multiple much higher. And so, in addition, as you said, the universe of buyers not only gets bigger, but it gets more credible, right? A buyer for a $500,000 earnings business is likely going to be another individual that may not have great resources to get a deal done. The buyers that we go to all have dedicated funds with lots of capital, so they can close a deal when they want to.
Yep, absolutely. And experience too, which is very helpful.
Yes. Yeah.
So how long do owners typically stick around for? What are you seeing these days? If you're looking to exit from your own business, you mentioned maybe a couple of years, but maybe the buyer's comfortable with you taking off after 12 months. What's typical these days?
It'll vary. Like for a private equity deal where a private equity firm is buying the business, they're going to want that team to stick around. And so a lot of our clients, not only will they commit to the couple years, they'll actually commit towards the next sale, which could be in 3 to 7 years. And they're incentivized because they've rolled some of their equity into that new business. They're incentivized to stick around and make that business worth a lot more. If it's a strategic buyer, where they're just getting cashed out, maybe that's a year or 2 years. Although we've had lots of clients stay on for longer because they just enjoy the work. But that's rarer. It doesn't happen as often.
Interesting.
Yeah.
So another topic I am curious about right now is, before about 18 months ago, we had been in this ultra low interest rate environment for about 15 years, right? And the way that capital flows kind of worked in that situation is bonds are not really attractive to institutional buyers. Stocks had been bid up substantially, especially since really the lows of the mortgage crisis. And so the forward-looking returns aren't that attractive for a lot of institutional managers. And for that reason, a ton of money has flooded into alternatives, and specifically private equity and venture capital. So that's, you see private equity funds, just the number of funds just kind of explode over the last 10 years because there's a lot of institutional money just plowed into that space. Now we're in a different environment. Inflation has crept back into the picture or vaulted back into the picture, depending on your perspective. We're in a higher rate environment. It's pushed down bond valuations with the increase in interest rates. What is the environment for deals like right now? How does that impact private equity behavior?
Well, you've put your finger and done a really eloquent job of explaining, hey, why we had so much capital go into private equity. The basically public alternatives, whether that was bonds or equity, they've gotten a lot less attractive. And so people plowed a lot of money into private equity. And, the amount of we call it dry powder, right? Capital that the private equity firms have raised but haven't invested, is nearing $1 trillion. My expectation is, as with all things, right? If you get a flood of capital into a particular area, that's going to result in depressed returns over some period of time. And that will create less demand for that type of investment. So at some level, I expect maybe the level of private equity capital raises or new fund creation probably is going to plateau at some point. What we're seeing in the market is, again, there's a lot of capital, both private credit as well as private equity, that are managing these deals. And any quality asset that we're bringing to market is getting an unusually large amount of attention because, there's a lot of businesses that just aren't going to market right now. So for example, we've taken a few businesses to market this year that I would put in that high quality, not impacted by a recession, great management teams, good revenue models, sizable, in those deals we're getting, one of them we had 25 bids, the other one we had 32 bids, the other one we had 42 bids. So there's a lot of attention being paid to high quality companies. We call it, kind of a flight to quality over. And one of the things that I don't think people, and you put your finger on it, that I don't think people necessarily appreciate as well is just how rare, a 0% Fed funds rate was. I don't think we'll ever see that again. The rates that we have right now are actually kind of close to the 70-year average that we've been, over the last 70 years. So it's not the environment that we're in, although it feels like it's really expensive, it's kind of normal, right?
Right.
And that has brought valuations back to earth. We saw some incredible valuations for software businesses, consumer product businesses that were predicated on growth when the interest rates were so low. Well, now, hey, that has tempered quite a bit. And so we've seen valuations come back a little bit, a turn or two turns. We've seen lenders get a lot more cautious, not willing to lend as much on deals. Interest rates are higher. And again, everybody views this as a big negative. I kind of look at it as, well, this is kind of normal, and we're going to have to adjust to it. I do think over time that probably results in less of a flow of capital into the private markets, as the public markets get more attractive.
Right. You mentioned that fewer companies are going to market this year. Why is that the case? It would seem to me that if I had a $3 million EBITDA business, that because of how quickly we have found ourselves in this more normalized interest rate environment, this capital doesn't flow through the system overnight. It's not an immediate reaction. And one thing we've talked about a little bit on the show is how this is reflected in house prices, right? Mortgages are way more expensive on a monthly basis for home buyers right now. People who have a house and a 3% mortgage are not moving because it's just really expensive to do that. But we haven't seen house prices really come down quite yet. And a lot of that is because this stuff just takes time to work its way through the system. If I'm sitting on a $3 million business and I'm considering an exit, it would seem like an attractive time to get this deal done before this higher interest rate regime really kind of works its way through and pushes valuations down further. Am I thinking about that right? Why are fewer companies going to market?
I think because there's less debt available, valuations have gotten
Okay.
a little bit compressed. Very, very few private equity exits are going on right now because they believe that they're waiting for interest rates to come back down when the buying environment can be more attractive. One of the things we're talking to business owners about is, hey, if that happens, right, if the private equity firms start to flood the exits next year, well, that's going to make it much tougher for an entrepreneur-owned business to stand out because there are going to be all these other businesses at market attracting capital, and there's a little bit of supply and demand dynamics. I also think businesses have had a number of struggles over the last year, 2 years, right, in terms of their own performance. And so they probably look at it and say, hey, I'd like to see the performance recover a little bit before I go to market. So my guess is we'll see, again, we're going to see a lot more companies coming to market over the next couple of years. Now, what that environment ultimately looks like, who knows? If I knew that, I'd be a lot wealthier. But, that's something to keep in mind. The other piece is, you still have this giant demographic issue of baby boomers that, there's a lot of, I think we saw an estimate, there's about $8 trillion of private company ownership value that the baby boomers own. Well, at some point that's going to flood through the system as well. It's happened later, I think, than a lot of people expected, but that is coming. And so again, there's a lot of different forces at work here that, in terms of, hey, how do you, one of the questions we get is, well, when should I sell my company? And my general advice is there's really 3 determinants to timing. It's personal timing, business timing, and then market timing. Well, personal timing, you've got ultimate control over. You can decide exactly what the right time is for you personally. Business timing, you really want to sell as the business is continuing to improve performance. Trying to time that to the peak is pretty dangerous. And then market timing, you can have a pretty good sense, but just remember that if you make a decision today to sell your business, even if you went to market tomorrow, that transaction is not happening for 6 to 9 months. And who knows what the market's going to look like then. So it's much more reliant, I think, on personal and business timing than it is on the market.
Yeah. Yeah. One thing anecdotally we've noticed over the years too, kind of expecting this baby boomer generation just to have some, at least modest increase in the number of deals going through, is that engaging professionals like yourself has opened the doors for a lot of these people that, hey, I don't have to pull 45-hour weeks anymore. I can move to Florida and get my monthly reports and kind of manage from afar and not be and that's a much better balance, because at the end of the day, if you're in that position where you have a fair amount of profitability being kicked off from your business, that's a pretty nice existence. Just keep raking in the cash flows and kick that can down the road a little bit. And I think a lot of these people you'd otherwise expect to liquidate as they get to, into their mid 60s are just having more fun hanging on to it, because you guys have helped them set that up in a way that makes sense for them.
Yeah, I think it's like any asset, right? If you're 65 and most of your wealth is concentrated in a business, I think there's some pretty good arguments to diversify that, right?
Mm-hmm.
Hey, you can't take the same level of risk you could take when you were 35, because at 35 you had many, many more years to overcome, a big downturn in your business. At 65, you don't have that luxury, right? So I think there's some wisdom in being thoughtful around, all right, how do I, make sure I preserve these assets? As a friend of mine texted me recently, I'm in the stay rich business, not the get rich business. And so, I think there's some wisdom to that. I don't know if you follow the Bolio brothers, right? And ITR, the economic forecasters, but, there are lots of conversation about a big depression coming in 2030. And I have no idea whether they're right or wrong. I know that there are some headwinds we as a country face demographically, with our debt, with our entitlements. So I think there are some legitimate reasons to say, hey, maybe it is time for me to get liquidity on this business and diversify my personal balance sheet. But that's a personal decision, right? I think, for me personally, I plan to work until I'm 90. So, there's no real big plan to sell this business. But I do think it has to impact your planning of, hey, as you think about managing risk, how do you do that? For us, it's, hey, we got to keep a lot of cash on the balance sheet so that we're not forced into making dumb decisions with our business. And that's going to be different for every entrepreneur. So, but I think that's the right conversation to be having, right? I assume that's what you're having with your clients is, well, how do you put all of this in context, right? You've got big macro forces, which you don't have any control over. And then you've got a lot of other forces that you do have control, but you want to put that in context of where they are in their life.
Yeah, that's very, very well put. Very well put. So you've experienced firsthand a whole bunch of transactions, and I'm sure you have some interesting stories from those transactions. What's the most oddball one that sticks? What's the craziest exit story that you've run into to date?
Well, there's as you said, we've had a lot of experiences, and every deal, by the way, has its ups and downs. And we like to say deals die 3 times, before they close. But we've had a lot of them that have been executed phenomenally well by entrepreneurs who I would put in the bucket of they are lifelong learners, they are intentional, they are planners. And then we've had some deals that have been where it just breaks my heart how much money that owner left on the table because they didn't put, a fraction of the energy into their exit planning as they did into the business planning. And, we had one in particular where, it was a client that, he had built his business the right way. And, if there's one thing I could leave your listeners with is, he went down the path with one buyer who called him out of the blue and for whatever reason convinced him to, hey, this is the time to sell and I'm the right buyer. Well, when you start down that path and you've done no preparation, it's not going to end well. I've watched it too many times, but I think these buyers are very effective at and they use a couple of things that I think that can convince this owner to go down this path. One is, maybe it's a good headline number. They never talk about structure. And the second thing, it's, hey, I can close this deal in 45 days. Well, that's just never true with a business that's not prepared to go to market or prepared to sell. It's going to take 6 months. But I think it's attractive to that owner. You mean I could be out of this thing in 45 days and get $25 million? And we've watched that movie over and over and over again, and it never ends well. Just never ends well. And so, one of the things that I always tell clients is, like in that business, I'll bet he gave that buyer $25 to $30 million of value because he just wasn't very well prepared. And so this, what you're telling your listeners, and I agree with, is, hey, you want to plan these things and be thoughtful, just like you're thoughtful with your business. Or, I liken it to, think about the biggest, client or customer sale they've ever worked on and how much energy they put into that and how much planning and how much time their team spent on it. Well, you want to multiply that by probably 10 or 20 times to get to the significance of a sale of their business, and think about that in terms of how much time they should be spending on their business. So that's the, in terms of common themes that we see, it's, the folks that have been intentional, have been thoughtful, or lifelong learners, and really, put that plan together and executed it. They just get results that are so much better than the folks that kind of just react and take that one call and think that's going to be their savior.
Yeah, that's excellent guidance. So what's next in your career, Chris? You mentioned you want to work till you're 90. What does that look like? You want to stay with the investment bank? Are you going to get into the private equity game at some point? What are your thoughts?
No, I love. As Warren Buffett says, right, I tap dance into work every day because I get to work with entrepreneurs every day. So it's just awesome, right? And I love our clients. I love our team. We have some unbelievably talented people on our team that make my life easy. And, the ability, I think as I've gotten older, one of the things that I've learned about myself is, look, I love closing deals and I love earning fees and doing all that. But one of the things that I've learned is that it's a lot less about the money as it is about serving others. And that includes the people on my team, the ability to watch them develop and hopefully, hey, I can help them create meaningful wealth for them and their families. If I can look back and say, hey, I created 20 or 30 millionaires that are doing great things in their community and taking care of their families, that'll be a great legacy for me personally. And it's just a lot of fun to grow a business. Like I said, I find a purpose in the work that I'm doing. I find purpose in helping these entrepreneurs. One of the statistic that I'm most proud of is we've kind of surveyed our clients. We have a thing, you can see it on our website, called the Why Project, which basically is, hey, here are all the organizations that our clients have helped. And we estimate that our clients, out of the $3 billion of transaction value that we've advised on, about 250 million of that has found its way back into the community through charitable giving, which is, for us as an organization, that helps you justify the long nights and the weekends and the work that we do. It's one of the things we're most proud of is how charitable our clients are, and what that means for the community. I don't think one of the reasons why we created the Why Project and we publish it every year, I don't think entrepreneurs get enough credit for what they give back to the community. And I don't think our community necessarily appreciates just how much sacrifice and how meaningful our entrepreneur clients are to the community. They're the ones doing all the hiring. They're the ones responsible for most of the economic growth. So I think we as a community owe it to them to support them.
It's really refreshing to hear you explain it in that manner, and I agree with you entirely. Chris, this has been great. I've really enjoyed the conversation. I want to be respectful of your time. You're a very modest promoter, I will say, perhaps too modest, but I can guarantee you that we have some people listening that are just, you've piqued their interest. You've written books. You have the firm's website. Where can we direct people to learn more about your stuff if they're interested?
Yeah, they certainly go to our website. It's www.class6partners, and class VI, the Roman numeral. It's named after difficult rapids you need a guide for. So but it's Class
Very
6 Partners.
Colorado.
Yeah. Class6partners.com. And I'm Chris at class6partners.com. And always happy to talk to entrepreneurs, even if we can't help them. Or they won't become clients of ours. We love helping entrepreneurs because we know kind of what they're putting on the line for us.
That's great. And the name of your book?
It's Harvest, the definitive guide to selling your company. I joke that it's like one of the top 10 Amazon bestsellers. The other 9 with the word harvest in them, the other 9 are about, marijuana growing. So, yeah.
Hey, you could get into that market. That's a budding industry.
Yeah, for sure. Yeah, exactly.
Well, thanks, Chris. I really enjoyed the discussion, and hopefully have you back on at some point in the future.
Well, thanks so much for having me, and thanks for doing what you're doing for the community and your clients and your business owners. That's awesome.
I appreciate it.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.